Good deal. And everybody, welcome to Forsyth County's Q4 Manufacturing Society meeting. My name is Alex Warner. I am the existing industry project manager for the economic development team for Forsyth County. I just want to thank everybody for taking time out of their morning to come and meet with us. We've got a really good program scheduled for you, and I want to get to it as quickly as possible. But first and foremost, we could not do this program without some help from our sponsors. And so I want to quickly run through those right quick and give Rodney, and we're going to hear from Alan and Cass in just a minute, but I'll give you guys just a second to tell everybody who you are. So Rodney's with Express Employment. Rodney, you want to say a couple words? Oh, and I think you're on mute right quick. So. And I also want to thank Wells Fargo. Andrew Shannon was not able to get with us, but if you'd like to contact Andrew for any reason, please reach out to me. I'll be more than happy to get you in touch with him. And of course, the Forsyth County government, they do a lot to help us with all of our economic development efforts in the county, and want to make sure that they know how appreciative we are of them. So without further ado, I'm going to turn it over to Cass Pittman. She is a partner with Smith & Howard, and I'm going to stop sharing my screen so she can show you everything that she has prepared for you guys about tax incentives for manufacturers.
Great, thank you, Alex. Let me set up my screen share now. There we go. Are we seeing the slides? Great. Well, thank you, Alex. It's great to be with you all today, even if it's only virtually, and I'm glad we're able to record it because hopefully everyone's power is coming back on. I know a lot of us have been experiencing that this morning, late last night. It's an honor for us to team up with the Forsyth Chamber of Commerce. Their investment in manufacturers like yourselves helps create a healthy business environment, and one we're very, very proud to support. See if I can get my slides to move here. So before we dive into today's presentation, I just wanted to give a little background. We have a lot to cover, so I'll keep it short. I am a tax partner with Smith & Howard, and I work with our manufacturing and distribution team. We're an Atlanta-based accounting and advisory firm, and we're also very proud to note that we were recently named the #2 accounting firm in the nation by Inside Public Accounting. We're headquartered in Atlanta, and we serve clients on both a local and national level. Joining me today is Paul McVoy and his team from KBKG, who will be speaking on research and development credits. This is a credit that we find to be very beneficial, but also very overlooked by manufacturers. I know presentations on Zoom can feel very long, so we'll do our best to keep this to the point, but hopefully there's some tax saving ideas that you can pull from today's presentation. For today's discussion, I wanted to highlight some tax opportunities and incentives for manufacturers in Georgia. I'll begin with covering a few opportunities that came up with the CARES Act, and Paul and Chad will speak to the research and development credit for opportunities available to manufacturers. And lastly, we'll finish up with some other incentives that we're seeing manufacturers be able to use and how these incentives and opportunities are changing in 2020. So, the CARES Act. To put it mildly, 2020 has been an intense year and full of change and uncertainty as we've all pivoted to a new norm. We've now hit the 6-month point, and from talking with clients and other business owners, it feels that everyone's reached their new interim new norm for their operations. I was recently told by a manufacturer that they don't know all the answers to everything popping up, but they have the procedures and their policies in place, so it's not a firestorm every time a question comes up. For them to see decision fatigue is fading, and they're getting back to operations on course. With that in mind, I think back to March when the CARES Act was released. Many businesses were dealing with all the changes that were coming out to their operations and massive operation alterations. Not to mention, there's a tremendous amount of information in the CARES Act to digest. Now that we are getting to our new norm, I wanted to walk through some of the things we've seen be useful to clients and different manufacturers that might also be useful for your business. We're going to touch on the business loss limitation, the changes to NOL carrybacks, changes to the definition of qualified improvement property, and payroll tax credits and deferrals. The first item I wanted to discuss was the change to excess business loss limitations. This is a provision that's available for non-C Corp entities. It feels like forever ago, but you may recall under the Tax Act and Jobs Cut that passed back in December of 2017, a new loss limitation was put in place for non-corporate businesses and limited their losses so that they weren't able to use a full loss in excess of $500,000 against other income. The CARES Act that came out in March eliminates this limitation for tax years beginning after December 31st, 2017 and through January 1st of 2021. So this can be very beneficial for owners of pass-throughs whose profits were affected by Corona in 2020. An allowance could be able to decrease their tax burden for this year. Along the same lines, the CARES Act also modified the usage of NOLs for all taxpayers in an effort to help get cash to companies at a time when they need it most. For background, prior to 2018, NOLs were able to be carried back 2 years, and then they could be carried forward 20 years. And they could offset 100% of any taxable income in those profitable years. The Tax Cut Act that came out in end of 2017 adjusted it where NOLs could no longer be carried back, but they could be carried back they could be carried forwards indefinitely. The other change to this also was that they could only be used against 80% of taxable income in those profitable years. Luckily, the CARES Act in March had two large changes. The losses created in 2018, 19, and 2020 can be carried back 5 years and can offset losses up to 100% of your taxable income. As in the past, when you're carrying back 5 years, you have to go all the way back 5 years and then apply the loss sequentially to income. So you can't cherry pick what year it goes to. But there could be additional benefit of carrying back a loss created in these years to prior years due to the tax rate difference. This would be especially important to C Corps who might be in a 21% rate this year, but if they could carry back their losses to 13, 14, 15, would be able to see a much higher tax rate. It's important to remember, as always, NOL carrybacks aren't always as beneficial to everyone depending on their actual tax situation. You need to keep in mind that if you carry back a loss to a prior year, there may be other items and deductions that are eliminated or decreased since they're based on taxable income. So you'd want to model out what that looks like for your situation. Another item to consider too is that not all states are going to conform to all the different changes in the CARES Act, and then NOLs are no different. Georgia has always had their own NOL carry forward and calculation, and so this has stayed the same. But something to keep in mind is some states went a little step further, and if you look at California, in July, they announced that they would not allow carrybacks, but even with their carry forwards, that they're suspending the usage of NOL losses for certain taxpayers for years 2020 through 2022. So if you're taking advantage of carrying back a loss, you'll want to make sure that you are still looking at your states to make sure that they are extended and paid in enough. Another beneficial provision of the CARES Act was the technical change to QIP, Qualified Improvement Property. You may have remembered, because there was a lot of news about it, that Congress intended to speed up the depreciation on qualified improvement property, but when the final regulations came out, the wording was not there. Generally defined, qualified improvement property is any interior improvement made to a non-residential building subject to some qualifications. And if it had been designated for the the intention was for it to be designated as a 15-year property instead of a 39-year property. And by being designated a 15-year property, it would then be allowed full 100% bonus depreciation, since that's currently available on all assets that are less than 20 years. This was a surprise when it came out that the drafted language didn't give QIP a 15-year life. And so as a result, all improvements made in 2018 remained a 39-year life and were not eligible for 100% bonus depreciation. The CARES Act provided the much needed technical correction to this problem by giving QIP the 15-year life and making it retroactive to 2018. So this gives an opportunity for businesses that put in qualified improvements back in 2018 to amend their returns to go back and claim that bonus depreciation. And bonus depreciation, unlike 179 elections, isn't limited to taxable income. So depending on the amount of improvements, and so the amount of depreciation, there may be an opportunity to create a loss. And with the aforementioned provision of being able to carry back losses now, there may be an opportunity to create a net operating loss and carry it back due to the additions that were put into place in 2018 and 2019. As I mentioned before, not all states will conform to all of these acts. Georgia does not conform to the bonus aspect, and Georgia does not generally allow bonus depreciation, but it did conform with switching the life to 15 years versus 39 years. So there is still a benefit for Georgia as well. And lastly, I wanted to bring up that the CARES Act did provide for some some payroll credits and deferrals to help with cash flow. The employee retention credit was a one-year credit against payroll for employer taxes, employer payroll taxes, up to $5,000 per employee paid before the end of 2020. Now, this credit is not available for companies that participated in PPP, so it might not be as widely used. And it depends on a two-part or an eligibility test that has two arms, and it's an either you only need to meet one of the qualifications in order to qualify. So the first one is the operations of the business was fully or partially suspended due to government orders. And the second is if the business remained open, but if any quarter in 2020 gross receipts for that quarter were less than 50% than what they were for that same quarter back in 2019. And if your gross receipts decrease is the reason why you can take the credit, then you can continue to take that credit in each quarter until receipts bounce back to 80% of what they were in that prior year. The payroll tax deferrals that we're seeing offer a way to lessen the deposit burden on employers who might be possibly struggling to make payroll by allowing them to defer that employer portion to be up to 2 years. So in this deferral, the 6.2% Social Security tax can be deferred from your payroll from March to December 31st, and 50% of that would be due December 31st, 2021, and the other portion due December 31st, 2022. And this provision is available to anyone. So there's no disqualifications due to receiving funds from PPP or a number of employee limitations. So this one is available to all, and it's easily implemented. You show the deferred portion on your quarterly filed 941s. And from here, I was going to turn this over now to Chad to introduce KBKG and give us more on research and development credits.
Yeah, thank you so much, Cass. And we appreciate the group allowing us to take the time to present to you today. So my name is Chad Niehaus. I'm the Regional Director for the Southeast region for KBKG. I'm currently in our Alpharetta office, so just south of most of you here in downtown Alpharetta. Luckily, there's power and internet here, unlike my house in Roswell. But we appreciate you all taking the time. with that, I'll tell you a little bit about KBKG. So we are a specialty tax firm focusing exclusively on engineering-based tax services. And I'm having a little trouble switching slides. Try that again. There we go. And so we specialize in R&D tax credits, as well as a few other incentives such as cost segregation and green building tax incentives, 45L, 179D, and also some international-based tax incentives as well. But we are one of the largest firms in our space with a nationwide presence. Of course, our Southeast office is located here in Alpharetta, but Paul McVoy is actually joining us from Philadelphia, and we are headquartered in Pasadena, California. But we have a diverse mix of tax specialists, attorneys, energy consultants, and engineers that make up our staff here at KBKG. But with that, I'll go ahead and hand it over to Mr. Paul McVoy to give an overview of his background and dive into the R&D tax credit and how it could potentially benefit your business.
Yeah, I appreciate that, Chad. So thanks everybody for joining us. As Chad mentioned, I work out of our New York City office, and I am currently located in Philadelphia where I live. I'm a director with the firm. I've been doing tax credits, tax compliance, tax provisions for 15 years so far. And prior to coming to KBKG and getting fully invested in credits and incentives for engineering credits and incentives, I was a manager at a Big Four firm in Philadelphia, San Diego, and Los Angeles. So that gave me a variety of clients based on the clientele within those different regions. So anyhow, I'm with us today because of my colleague, John Tucker, who's a director out of Atlanta, had a prior engagement. So I'm stepping in with him, but we have a pretty robust Atlanta team, and Jessica Bowen, who's a senior in Atlanta, is going to be helping me present the R&D tax credit. So please, as we work through this slide deck, feel free to use the chat box if you have any questions that you would like to present as a group. If you'd like them to send them specifically to me, please do so, and we can discuss those and make it more of a back and forth. We'll also leave time at the end for a Q&A. So with that, I'll let Jessica introduce herself, and we will get into the presentation.
Thanks, Paul. Yep. So like Paul said, my name is Jessica, and I'm a senior here in the Alpharetta and Atlanta office. I have a background in electrical engineering technology, Six Sigma Green Belt, as well as an MBA. So I like to say I bridge the gap between technical and business. So these R&D tax credits are right up my alley. Prior to working with R&D, I did a lot of data and business analytics for the aviation industry, as well as some software firms. And I primarily focus on R&D credits for engineering technology companies, general manufacturing, food and beverage manufacturing, software, and also agronomy, because there is a lot of technology in agriculture these days.
All right, thanks, Jessica. So we're going to get into the benefits of the R&D tax credit, and I believe it's critical to understand the process in which costs and activities are captured, which Jessica will talk later about. We'll start with the general credit overview so everybody has an idea of how beneficial this incentive is. What I like to tell potential clients and CPAs when I speak to them is to think of the R&D credit as a jobs credit. Frankly, it's a domestic incentive to increase highly technical jobs and to increase innovation within the U.S. So if we're hiring engineers, computer scientists, or at least we're hiring people who rely on engineering and computer science or one of the hard sciences to do any sort of activities for our company or create new products or improve new products or improve processes, then we should be thinking there's probably an R&D credit that's available to us. And that credit can range anywhere from 6 to 10% of every expenditure that's made. That includes the federal credit, which is fairly robust with a couple different methodologies to calculate it, as well as state credits. Georgia has a nice incentive as well from an R&D standpoint. This is a dollar for dollar reduction in tax liability. And one of the things I like to tell people in my discussions is that, you know, everybody has a silent business partner, and that silent business partner is Uncle Sam. Meaning, if we make any money, some of that some of that cash is going to go right into Uncle Sam's pocket. And the R&D tax credit is a way to take dollar for dollar some of that money that's going to Uncle Sam and put it back into our pockets to continue to reinvest in our companies. So obviously it lowers our effective tax rate. It can improve earnings per share. Frankly, I think one of the most important things on this slide deck, is that we can go back and claim retroactively any credit that we're entitled to for years that are still open under statute. And that's generally going to be 3 years for federal purposes, meaning if we filed a 2017 tax return in March of 2018, that means we have 3 years from that March of 2018 deadline to claim those credits. So we could claim 17, 18, 19, and then 2020 tax returns. So keep that in mind. If presentation gets any light bulbs to go off and think, hey, we may be eligible to claim this credit, I think we should have some further discussions, whether it's with Chad or with Cass or anybody in the future. Note that it's not only for this year that you can get that benefit, but certainly for the few years past. So the next couple of slides are going to give you an idea at a very high level of the amount of credits that are claimed. So what you'll see on the next slide is a chart which represents the total amount of R&D credits claimed since 2008. So we estimate that there's nearly $17 billion of R&D credits claimed by companies through 2018. And frankly, we think that's only scratching the surface of the credits that should be claimed. And why is that? Well, frankly, we believe it's because many companies hold their own expertise against them because they're doing things that are innovative every day. They think it's their job to be innovative, and they're not going to capture credits because it's routine to them. But it's not routine to the industry, and frankly, it's not routine to most people. That's one reason companies don't claim the credits. Another reason is they're not aware. They're not aware of the credit being available. I know right now we have a primarily manufacturing audience here, and we don't have the slide that we usually have in webinars like this that talks about the different industries that claim the R&D credits, but manufacturing is the largest industry claiming R&D credits. So a lot of times it isn't because they aren't aware. It may be the third reason, which is, oh, well, I get I'm entitled to a credit, but what's this going to cost me in terms of time or in terms of money? And that is it's an important question to ask, and it's something that needs to be considered. But frankly, the R&D credits benefit is usually going to outweigh any sort of the cost that that you would incur in getting that credit onto the tax return. So the next slide again is just an overview of the types of companies claiming R&D credits. And what you'll see here is companies with over $100 million in revenue tend to claim almost 90% of all the credits that are available. And why is that? Well, the first reason is if we're making over $100 million, we have more money to spend performing R&D. And if we're spending more money performing R&D, we're going to generate larger credits. But we do believe that slice of pie will decrease over time because many of the mid-sized and smaller businesses, whether in manufacturing or in other spaces, are certainly going to become more aware of this credit being available, and all of the innovations that are taking place at these different entities will give them an opportunity to claim the credit. So this is just a quick overview to ensure that everybody sees what types of credits are available, not only to the largest companies, but to the smaller companies as well. So with that, we're going to get into the R&D tax credit overview, understand the process in which costs and activities are captured, like I mentioned before, and I'm going to turn it over to Jessica to do so.
Thanks, Paul. So here you'll see what we call the four-part test. So when a lot of people think about research and development, they think science labs and white coats and test tubes, and that is not necessarily the case. The R&D credit was created to cover a much more broader spectrum of businesses, of industries. And so the four-part test is our high-level guideline that we constantly keep in the back of our heads when we're thinking about a business or a company or an activity to say, hey, would this qualify for R&D? So I want to walk through this four-part test with you, and maybe you can start thinking about your business and how it applies. But the first test is going to be, are the activities technological in nature? So is it fundamentally relying on a hard science, an engineer, a computer science, and not so much a soft science or arts or humanities? So step one is it technological in nature? Two is it being developed for a permitted purpose? And so when I say it, I'm referring to the project or the business component. And you'll see that word business component throughout section 41. And the term business component basically just means, is this a product? Is it a process? Is it a new formula? Is it a new technique? What exactly are you developing? And our permitted purposes, there's 4 key words, are functionality, performance, reliability, and quality. So are you creating this new product to improve the performance or increase functionality, or are you implementing a new process improvement to just overall improve the quality of your products and your operation? So those are 4 key words we always want to make sure is the reason why a project is being completed. And then the last 2 I always go hand in hand in my head with are elimination of certainty and process of experimentation. So elimination of uncertainty is basically at the outset, do you know exactly what needs to be done in order for this project to be successful? Or are there some questions and maybe alternative ways to go about the overall design, the overall methodology in producing it, or even if you have the capability, maybe you don't have the equipment and machinery necessary to even be able to produce something to specific specifications. And so the process of experimentation is, how are you going to eliminate that uncertainty? Is it going to require you to do modeling or schematic designs or just a trial and error process? So your process of experimentation can come in a few different forms, but those 2 tend to go hand in hand. So I want to walk through some of the overall qualified expenses that we can capture. So once you've identified, hey, this sounds like we meet this criteria, these are the different expenses that we can capture regarding those activities. So first, and typically the largest bucket we see, are employee wages. So employees that are conducting these R&D activities, we can take their taxable income and apply a percentage of their time working on R&D credits. And so when I say taxable income, we want to make sure we're excluding, any pre-tax dollars, 401k, things like that. So we typically want to look at that box 1 wage on individuals' W-2s. That's going to be their taxable wage. The next bucket is going to be supplies. And so the Internal Revenue Code defines that as tangible property used or consumed in research and development. So if you're building a pilot model or a prototype, any of those supplies that go into physically producing that product. A few exceptions there. 1 is we can include land, and 2, which we see in manufacturing a lot, is we can't include depreciable items. So some of the larger equipments, the CNC machines, things like that, we can't claim those expenses, but we can claim the expenses that the time that employees are spending working with those types of items. And then the third category is going to be contract research. So if you're utilizing any third-party services to conduct research and development, whether that's using an outside testing facility or contracting for a designer or any type of services that assist you in producing that new product or implementing that process improvement. The rule of thumb there is we can capture about 65% of those expenses, and 99.9% of the time I see that category falling in the 65% realm. There are 2 other buckets if it's a part of a research consortia, or if it's for higher education and federal laboratories, you can bump that percentage up higher to 75 or 100. But the rule of thumb is typically 65% of contract research expenses we can capture towards the credit. Right. So under the employee wages, I want to just dive a little deeper into who we can actually capture. So of course we can capture the individuals that are directly performing the R&D activities. So the ones that are physically doing the designs, physically putting together those prototypes, physically conducting your testing. But we can also look at what we say a level up and a level down. So those individuals who are directly supervising the folks that are performing R&D, as well as those that are directly supporting those performing R&D. And on my next slide, I believe there's a few examples. So for direct supervision, that can be, of course, your first line supervisors. Who does that individual directly report to? It can also be the folks that are reviewing your technical designs, or even the ones that are communicating requirements down. So your designers and engineers won't know what they're making unless someone is telling them some of the requirements and specifications. And it's important to note that your direct supervision category, those individuals can also be directly performing. You can have a first line supervisor that's, still getting their boots dirty out on the floor and conducting some of the R&D work. And then for direct support, that's that one level down. There's a few different types of activities that are considered direct support, but I think for manufacturing, the main category that we see them falling under is that maintaining and cleaning research equipment. So if you want to try a new product on your equipment, you may have to change some specifications and the way that your equipment is set up to run. I know I keep mentioning CNC machines because I feel like it's a great example that requires different programming and things for whatever you're running on it. So the folks that are helping get that equipment the way that you need it to be would be considered direct support, as well as at the end of the day, if that equipment needs to be cleaned up and reset and ready to go for a new prototype to be produced the next day, we can also take their time. Right. And then now I just want to go over some of the activities. I know I've been giving a few examples, but just high level categories. So overall design work, your folks that are on the computer doing CAD drawings or, putting pen to paper and doing some of the schematics, as well as modeling and analyses. The physical prototype development. So the folks that are not just doing the design, but also building that prototype or that pilot model, as well as testing. And testing comes in a lot of different forms. It can be computer modeling, simulations. It can also be actual physical testing and field tests, just making sure that it's meeting performance requirements. And a lot of times when I think about this testing category, it directly correlates back to that process of experimentation in our 4-part test. So if you can think of testing that's occurring for your product or your process, you likely meet that process of experimentation in that original test. And then also another question that we get frequently is, when does the clock stop? We're looking at qualified activities. So from that initial concept down to the product being ready to release for commercial production, that is when that clock stops. And then lastly, your R&D is not contingent on success. So your product or process does not have to be successful in order for you to claim the expenses. A lot of times if a project is not successful, that just shows even more that that uncertainty was present and you further qualify. And so some of the specific qualified activities for manufacturing, and I won't necessarily read through all of these, but the software development component for your manufacturing facilities, getting your automation controls up and running. From the outside, folks that work in finance and even IRS, they may not necessarily think about all of the technology that goes into making a manufacturing facility run. So just think about all of the different technology components and making sure that they're the way that you need to perform. That would qualify towards the credit. As well as trying and experimenting with new materials. So can you get these new materials to produce a product to the same quality that you need in order for it to be functional? A few other examples on here is scaling up a manufacturing process. When you make one piece and then have to make a bunch of them, it's not always that simple. So your scale up process, if there's some trial and error there, as well as running just trials in both your pilot plants and production facilities. And so there's a wide variety of activities. Those are just a few to highlight. And then on this page, we did want to drop in some qualifying R&D job titles. And Paul, I think we're one slide ahead if you'll go back for me. One more. There we go. So some qualifying job titles, and whenever we're looking at the employee roster of a company and we see the individuals that work there, these are some job titles that immediately jump out to us and we say, hey, there's some qualified R&D work here. That's going to be anyone working with your CNC machines, any type of engineer, whether it's design, packaging, reliability. Your machinists are going to fall under that direct support category, as well as your quality assurance managers are typically constantly working on continuous improvement and implementing some of those process improvements in your facility. So I've talked a lot about what does qualify. I do want to touch base on some of the things that do not qualify. So first, the R&D credit is a US-based credit, so we can only capture expenses for activities that are occurring on US soil. So if we're using a third-party facility overseas to conduct any testing or anything like that, we cannot use those expenses. It also has to be a new or improved product. It can't be something you've already developed before and now you just want to adapt it for another use or just change the color and duplicate it. And again, it does have to be in the hard sciences, not soft sciences, routine data collection and QA testing. So I don't like the phrase QA testing. However, that is how it's worded in the Internal Revenue Code. When they mentioned quality assurance testing, they're talking about routine, you've produced this product, and now I just want to spot check and just make sure that, you know, our batches are coming out correctly. In my mind, I consider that quality control. So the QA, the quality assurance testing, the front end, the making sure that you're meeting specifications, still working on that pilot model first run, that side does qualify, the second half does not. And then also funded research. So do you maintain the rights to the work that you're conducting? And then again, anything after commercial production, which some examples are on this slide, which is just going to be, hey, you've produced this product, now it is out into production. If you run into any debugging issues, we typically cannot qualify that because at the end of the day, you have a viable product. These are just some tweaks that we're going to do on the back end. All right. And so that's everything that I wanted to cover. I think Paul is now going to go over audit activities for you guys. So I'll turn it back over to him.
Yeah, thank you, Jessica. Excuse me. So knock on wood, and God forbid our return is selected for examination. The IRS or state examination authorities will generally want to look at certain areas. This is how they're trained, and I'll get into that in a minute. So over the next couple of slides, we're going to talk about these areas of controversy. And again, if you have any questions, I know there's a Q&A portion of the presentation that we'll have later, but feel free to put them into the Zoom group chat. So on this slide, you'll see some of these areas of consideration. And frankly, when the IRS takes a look, or the state examination takes a look at any study, they're going to ask about nexus. But really what they want to understand is, tell me the activities that are being performed, how they qualify for R&D, and then show me the nexus between the expenses that you're claiming for them. For example, if we have an engineer or a manufacturing engineer who's working on a brand new manufacturing process, and we're paying that individual $50,000 or $100,000, they're going to want to understand how those activities relate to that W-2. And they're going to really focus on areas that are gray. And substantiation is really where they're going to try to hammer us. So on the next slide, we talk about what is substantiation, right? And again, they're trying to understand the nexus between qualified business components and the activities and qualified individuals, and how do we substantiate the work that's being performed? Well, that's going to be through documentation. The R&D credit does not keep any specific R&D record-keeping requirements, meaning if you claim the R&D credit, you don't have to put together any sort of specific R&D credit work papers. What you're able to do, and what the IRS and the legislation wants companies to have, is the flexibility to provide any documentation that they're creating in their day-to-day business. They want companies to have the ability to innovate without thinking about paperwork for some incentive. They don't want the tail to wag the dog, per se. So companies should think when they're doing R&D, what types of documentation that's already available would help support an R&D credit claim. And if a company is qualified under, has an ISO certification and that goes through their R&D development process and all the sign-offs necessary to go from stage to stage, that'll be something that's really good to lean on. Additionally, if we have a product development life cycle that we work through where idea concepts are brought either internally or from customer interaction through our sales team, which then go to management for discussion to determine whether or not they're feasible from a cost perspective, but also from an engineering perspective. Those types of items for the IRS to understand what the company does will be very critical in any sort of exam. Now, just so everybody knows, I believe the last stats that I saw related to examinations were 1% of all tax returns were selected for examination. Claiming an R&D credit does not increase your likelihood for being examined. I want to make that clear. If the tax return does get selected, though, there are a few things the IRS is going to look at almost immediately. And one of them is the R&D credit, the foreign tax credit, transfer pricing, things like that, because they're going to provide the most bang for their buck. So on the next slide, and I'm trying to work through here. I know we have 4 minutes left. I want to be respectful to everybody's time and make sure there's enough time to get through all the slides. And this is our last slide. But here are some examples of contemporaneous documentation. What's the key word here? But that's contemporaneous. What the IRS likes to see is this documentation is created as R&D is being performed. Unfortunately, the IRS or any state examiners happen to come in and question not the current year R&D that's being performed, unless we're in the CAP program. They're going to come in and ask questions about 3 and 4 years ago. And this was probably more lucrative to the IRS 10 years ago when everything wasn't kept online, but nowadays things are. So what types of documentation would be helpful in the event of an audit? Well, generally any deliverables that are created as we go from phase to phase, from development, to commercialization. If we have project budgets which show which people are supposed to work on a project. If we are running first article pilot runs in our manufacturing plant, and our system that we use to track all the different lots in our manufacturing plant are coded that it's a pilot run versus a production run, that's going to be very helpful in supporting and substantiating what we're claiming. Patent applications, there is a safe harbor, meaning if we develop any product or manufacture any product which results in a patent, we can use the safe harbor to say that it meets the 4-part test. So again, this isn't an all-inclusive list, and one of the things that we do when we talk to different clients is have a discussion. Usually that'll be with a project manager or an operations manager who understands the development process and the manufacturing process, to give us examples of documentation that's created. Again, the exercise should be more of a drag and drop exercise, not necessarily something that we're creating from scratch to prove that we're doing R&D. Some companies have more robust documentation than others, and that's usually going to be a function of how mature the company is. And for some of the companies that are still in their initial stages of growth, we have to look at emails. And emails will show, or meeting minutes will show, and sometimes if we're claiming executive compensation for people who are higher than the people doing the work on the ground, we'll have meeting minutes or calendar invitations that show, hey, every Friday we meet for an hour and we talk about the products, where they are, what type of improvements could be made. So my timer says I have 1 minute left, so I do want to go over one thing that I think is important. The audit technique guide is publicly available, and these technique guides, they have them for all different things, different industries, how to audit a wine industry. They also have it for the R&D tax credit, and frankly, this is what the examiners use to and are trained with. And a lot of the audit technique guide has since been made it has since been superseded because they've had some fights in courts. But if you ever wanted to understand what somebody is going to look at related to your R&D credit, the audit technique guide is certainly something that can be looked at and viewed and utilized when preparing any sort of response related to an R&D credit. So with that, I have 30 seconds. I want to thank you for your time and turn it over to Chad.
Thank you, Paul. Appreciate it. And here's my contact information. If anybody has any questions and you're not able to think of them or get to them today or this afternoon, feel free to reach out to me anytime. But with that, I will go ahead and give it back to Cass to continue the presentation.
Great. Thank you all for all of that information. That was very helpful. I just wanted to cover 3 additional credits that we normally see in the manufacturing industry that could be helpful in the changes that we're seeing as we close out 2020 that you might want to consider. You probably have some familiarity with these credits, so I'll just touch on the basics and kind of give you the overview of what we're seeing and what opportunities may be there. The Georgia Retraining credit, this credit was created to encourage workforce development and investment in new technologies. It's generated from retraining costs for both new and upgraded software. So as in the past, the credit is limited to 50% of your direct training costs per program and can go up to a maximum of $1,250 per employee per year. On average, we see companies get around $1,000 per employee for the ones that apply for this credit. The usage of the credit is also limited. It's limited to 50% of the current year income. But if your credit created is more than your current tax liability usage, you can carry that forwards for 10 years. And then it's just limited to 50% of your current income tax liability each year in those years. Just some things to touch on. The credit's available if you have full-time Georgia resident employees, and they have to have been with the company for at least 16 weeks. Where we're seeing some opportunity increased in 2020 includes the increased training costs that we're seeing for virtual technologies. So investments for technologies like Zoom for presentations like this or webinars like this, if you're using Teams internally. We've also seen an increase in training for virtual payment processing applications, if those have had to be installed since COVID. We generally always see some benefits with any warehouse automation integration with your business software platforms. But we're also seeing some training on new equipment and programs used for sanitizing and different COVID safety technologies being put in. In general, the credit can be used for new software, additional modules, new seats for existing software. So if you added more employees on, it can be used for internally developed programs. So if you're making updates to your ERP or CRMs or warehouse management systems, these will all be things to look at. And with this credit, to keep in mind, this credit has to be approved by the Georgia Technical College of Georgia before being claimed on a tax return. So you do need some lead time because that application has to go in and get approved. And we're seeing a time of about 30 plus days in order to get that approval through. The other Georgia credit that's generally very helpful, but there may be some opportunities for more taxpayers to take advantage of in the future years, is the Georgia Job Tax Credit. And with the expectation that there might be an increase in new hires for companies going past this 2020 year, the Georgia tax credit may be available when it wasn't in the past. I'd like to remind everyone that Georgia tax job credits need to be looked at in conjunction with your Georgia investment credit, because you can only take one of the 2 credits in 1 year. But the benefit that's available from each of those credits is dependent on the company location, and that puts your company in a certain tier. And so the benefit ranges from $1,250 to $4,000 per job. And of course, this is a 5-year credit. So once you meet the threshold of new jobs, then if you maintain those jobs, you would receive the credit per person for the next 4 years. And to keep in place and I kind of flipped forward, so it's almost done. But to also keep in mind, the qualifying jobs are 35 hours a week, and they have to meet the minimum wage requirements, which we've seen the state looking into this more recently. And that, as of June 2020, was $541 per week. And the jobs must have health insurance offered, even if the employees do not take you up on that. This credit is used against income tax. Depending on your tier, 50 to 100% of your Georgia tax liability. And anything that's not used towards income tax, if you're in a tier 1 or tier 2 location, can be used against your payroll taxes as well. And specific to this year, companies that have claimed the jobs credit in the past, so are in their 5-year window, so 2016 or later, have the opportunity to use pre-COVID numbers for their maintenance level jobs. So if they are unable to maintain their jobs going from 2019 to 2020, for tax years 2020 and 2021, you have the option to actually use your 2019 job numbers. So this will give the opportunity for some people that have had to pull down their employee base to still be able to claim the credit. This change does not change anything for companies looking to start the credit in 20 or 21. This is only for companies that already have the credit in place. But as mentioned before, as hiring picks up after 2020, there'll likely be some opportunities where companies that previously were unable to meet the new jobs thresholds for their tiers may have that large hiring. So it may be worth making sure that you're tracking your average jobs per month so you can see that year-over-year increase. And lastly, in response to the jobs, in conversation with the jobs credit, the state also has a new PPE manufacturing credit. And this is on top of the jobs credit. It's $1,250 per employee for jobs that are dedicated towards PPE. It's very similar to the jobs credit. It has the same 10-year carry forward. There is a smaller range of years that can be used in, but this would be something that could be used if any part of your plant has been converted over to create products for COVID safety or hand sanitizer. So this would be a credit to look into. And lastly, just wrapping up, I did want to touch on just the work opportunity credit, the WOTC credit. This is a federal credit, not a Georgia credit. But I wanted to bring it up in the thoughts of when we're looking at hiring, starting back up. The WOTC credit can be really beneficial, but you have to have the processes in place to capture the data and get the new employees certified at the date of hire. So it's not a credit that you can look back at the end of the year to see if there was any benefit. Once you have the processes in place, it is not too cumbersome. But the credit is available for employers that hire employees in 14 target groups. And the credits range between $1,200 and $9,600 per qualifying employee. Where we see employers in finding people in these target groups have mainly been in the veterans group, the long-term unemployment recipient group, and the employees receiving public assistance group. Those would be the categories we see at most. Since May 1st, there's definitely been an uptick in potentially eligible new hires. And it seems there's probably a 15 to 18% uptick in certain companies, mainly due to the unemployment employees that are being brought on. And lastly, I wanted to mention, because you may have heard of it back in July, that there was planned to be a new WOTC target group that was going to be for individuals receiving unemployment. And it was going to be a target group that had a $5,000 credit. And the only requirement was that the new employee was receiving unemployment compensation before hiring. This was on the table, but it was not written in. So as of right now, it's off the table and is not available, but we are hoping that this is something that could be revived, being that it would be eligible as written previously for new hires and rehires, so it could be very beneficial. That takes us to the end of our presentation. I know we've covered a lot. We really appreciate all the time you've given us today to go through all this. And I know there's a lot of new incentives out there and a lot of modified incentives, and hopefully this gave you some ideas on some options that might be available to your individual tax situation. And I'm sure KBKG and myself are more than happy to take questions now, or if questions come up later, please feel free to reach out to any of us.
And Cass, I want to thank you and KBKG and the whole team. Thank you so much for putting this together for us. I know that this is kind of a touchy subject that people don't feel like they need to ask questions in a public setting like this. So if you would like to ask them privately, all of you should have my contact information, or we can get Cass to put her contact information back up on the screen if you would like to reach out to her specifically. Thank you so much for taking some time to join us this morning. This is our Q4, so we're going to wrap up our Manufacturing Society meetings for the year of 2020, and we'll be looking at doing our first one in January. We're hoping to do our Q1 in an actual in-person live event. So if any of you would like to open up your I knew she was going to join at some point. If any of you guys would like to open up your facility for us to come and do our live Manufacturing Society meeting for Q1 of 2021, please reach out to me. We'll be more than happy, or we'd be grateful to have a host. I don't see any questions that have come across the chat, and with what we were expecting with the content that was being delivered. If you do have anything and you would like to reach out to KBKG, or you'd like to reach out to Cass with Smith and Howard, please let me know. And with that, I'm going to turn it over to Alan Najar to close us out.
Thanks, Alex, and thank you, Cass. Hopefully y'all heard today that our firm that's 50 years old with about 130 people in it, with almost half of those being tax people, Cass and her partners either have the answers or they know where to go and get the answers. So we have a lot of affiliations and alliances with companies like KBKG, where we don't need to know all the nuances, but we need to know who has that. While we are an Atlanta-based firm, we have a national and an international reach. And through that, we're able to deliver Big Four services for a fraction of the price that Big Four charges. So the expertise that companies need in a constantly changing and dynamic environment, we have it, or we know where to get it. So Cass, thank you for your time in putting this together and for bringing our partners in from KBKG. Excellent presentation. As Alex said, the slide deck that they presented is available, and the recording also, so we're happy to take any questions offline as you see them. Thanks, Alex, for putting this together.
Of course. Thank you, guys.
Thank you.
And the recording will be available, and I will send it to everybody that joined the call, but also everyone else that usually participates in our events. So if you know of anybody that could use this information, please feel free to share the video or the slide deck with whoever could use it. All right. Thanks, everybody.
Great. Thank you.
Thanks, everybody.
Thanks, Cass.
Thank you. Bye, y'all.